Seven companies now stand at the center of the American stock market, not as participants, but as its foundation. Their names are spoken daily on news channels, whispered in investment forums, and embedded into retirement plans without question. Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla are no longer just corporations. They are pillars. Together, they represent innovation, growth, and the promise that America's economic engine is still alive. But history warns us that when belief concentrates this heavily, fragility follows. Markets appear strongest right before they become dependent on a narrow source of strength. What looks like stability is often just repetition disguised as diversity. Every index, every fund, and every algorithm leans on the same small group of names. The illusion is subtle because prices are still rising and confidence still feels justified. But real strength is broad, and real resilience does not rest on seven balance sheets. This is not the first time an empire has mistaken dominance for safety. Power always feels permanent when it is most concentrated. The Magnificent Seven did not conquer the market through force but through necessity. Investors did not choose them individually, they were herded into them collectively. Over time, choice disappeared, replaced by automatic exposure. What remains is a market that appears diverse on the surface but singular underneath. When leadership narrows, risk does not vanish, it multiplies invisibly. And invisible risk is the most dangerous kind, because no one prepares for what they no longer see. This is how every collapse begins, not with panic, but with comfort. The combined market value of the Magnificent Seven now exceeds $7 trillion. That number alone should trigger discomfort, not pride. It is larger than the GDP of most nations on Earth. It outweighs entire sectors, industries, and decades of accumulated labor. Seven companies now represent a financial mass so large that the system bends around them. When numbers reach this scale, they stop reflecting reality and start distorting it. Valuations are no longer anchored to output, but to expectation. And expectations are fragile things when they grow faster than the world that must support them. $1 trillion assumes permanence, endless growth, and uninterrupted dominance. History has never rewarded those assumptions. Empires fall when scale outruns substance. Markets break when size eliminates flexibility. At this level, even small disappointments become systemic events. A missed earnings call no longer hurts one stock. It shakes entire indexes. A single downgrade ripples through retirement accounts across the nation. The number is impressive, but it is also a warning, because markets are not designed to carry infinite weight at the top. When value stacks too high, gravity does not ask permission. It simply pulls downward, and $7 trillion leaves very little room for error. Investors are told they are diversified, but most portfolios now tell a different story. The S&P 500 claims to represent 500 companies, yet its performance is driven by only a handful. The Nasdaq appears broad, but its fate is tied to the same familiar names. What once spread risk now concentrates it. This shift did not happen overnight. It happened quietly through automation. Index funds removed decision-making and replaced it with mechanical buying. Every dollar that enters the system flows toward the same stocks, regardless of price. Fundamentals no longer decide value, flows do. Diversification became a label, not a reality. Investors stopped owning businesses and started owning exposure. And exposure does not protect against collapse. It amplifies it. When selling begins, it will not discriminate. Algorithms do not believe in loyalty or long-term narratives. They respond only to signals, thresholds, and exits. The same structure that lifted the Magnificent Seven will accelerate their fall. This is the paradox of modern markets. Safety was automated and risk was hidden in the process. When diversification died, concentration took its place. And concentration always demands a reckoning. The modern market no longer asks investors what they believe, only how much they contribute. Passive investing promised safety by removing emotion, but in doing so, it also removed judgment. Index funds do not analyze companies, question valuations, or anticipate risk. They buy because they must, not because they should. Every paycheck contribution becomes a silent vote for the largest stocks in the index. Over time, this creates a self-reinforcing loop where size attracts capital and capital creates size. The Magnificent Seven benefit not from superior performance alone, but from structural favoritism. The more they rise, the more weight they gain inside indexes. The more weight they gain, the more money they automatically receive. This is not market efficiency, it is mechanical dominance. Price discovery weakens when buying is unconditional. Risk hides when everyone believes they are diversified by default. The system rewards scale, not sustainability. It assumes liquidity will always exist because it always has. But liquidity is not a law of nature. It is a fragile agreement. When confidence breaks, automation accelerates the exit instead of cushioning it. Passive strategies were built for calm markets, not systemic stress. They work perfectly until the moment they fail simultaneously. And when they fail, they do so without hesitation or mercy. This is how safety quietly transforms into systemic danger. Every era believes its champions are different from those that came before. In the 1970s, it was the Nifty 50, companies considered too strong to ever fall. In the late 1990s, it was the dot-com titans, symbols of a technological future that felt inevitable. Each group was justified with logic, data, and confidence. Each was supported by innovation that genuinely changed the world, and each collapsed not because the innovation failed, but because expectations outgrew reality. Markets do not punish success, they punish excess belief. The Magnificent Seven now carry the same myth of permanence. They are treated as essential infrastructure rather than competitive businesses. Their dominance is explained as efficiency, not concentration. Their valuations are defended as vision, not speculation. But history shows that dominance always breeds complacency. When leaders become symbols, criticism becomes taboo. When criticism disappears, risk grows unchecked. No empire collapses while everyone agrees it cannot. It collapses when confidence becomes consensus. The lesson history repeats is not subtle, and it is ignored. Power centralizes, belief follows, and vulnerability multiplies. The past is not a warning sign because it looks unfamiliar. It is a warning because it looks identical. The rise of the Magnificent Seven was not accidental. It was engineered by incentives. Corporate buybacks reduced share counts and inflated earnings per share. Cheap capital rewarded growth narratives over profitability. Media reinforced winners because winners generate attention. Algorithms amplified momentum because momentum drives engagement. Analysts hesitated to challenge consensus because deviation carries career risk. Regulators watched concentration grow while calling it innovation. Meanwhile, smaller companies slowly disappeared from relevance. Capital stopped flowing toward experimentation and started flowing toward certainty. The market did not become smarter, it became narrower. Risk appeared lower only because it was centralized. When fewer companies matter, fewer failures are tolerated. The system becomes efficient, but also brittle. Fragility increases as redundancy disappears. Diversity in markets is not cosmetic, it is protective. By concentrating value, the market removed its own shock absorbers. Success became uniform, and uniformity breeds systemic exposure. This was not greed alone, it was comfort. Comfort is always the enemy of resilience. And resilience is the first thing sacrificed before collapse. Artificial intelligence became the perfect narrative to justify infinite growth. It is real, transformative, and powerful, which makes it dangerous as a story. NVIDIA emerged as the physical backbone of this narrative. Its valuation reflects not current demand, but future dominance priced in advance. Markets began treating AI spending as inevitable rather than cyclical. Revenue projections expanded faster than real-world adoption. Margins assumed permanence in an industry defined by competition. Every company became an AI company overnight, at least in presentations. The promise of productivity replaced the measurement of profitability. Investors stopped asking when returns would materialize. They asked only how big the opportunity could become. This is the moment where innovation transforms into mythology. Technology cycles always begin with optimism and end with discipline. When discipline returns, valuations adjust violently. AI does not need to fail for the bubble to burst. It only needs to disappoint expectations inflated beyond reason. Markets punish timing errors more than wrong ideas. Being early feels identical to being wrong during a correction. The AI story lifted the Magnificent Seven higher than fundamentals alone ever could. And stories collapse faster than balance sheets. At extreme scale, growth stops being a strategy and becomes a mathematical problem. The Magnificent Seven are no longer competing against rivals. They are competing against their own size. When a company reaches trillions in valuation, even exceptional performance produces modest percentage gains. Expectations, however, do not slow down with size, they accelerate. Markets demand exponential growth from businesses that now operate in saturated global environments. Every new customer becomes harder to acquire, more expensive to retain, and less profitable than the last. Expansion shifts from innovation to optimization, from growth to extraction. Margins are defended not by creating value, but by cutting costs, consolidating power, and raising prices. This phase is rarely visible in headlines, but always visible in internal decisions. Growth projections begin relying on financial engineering rather than organic demand. Buybacks replace reinvestment because they are easier to justify. Acquisitions replace innovation because they appear faster. The story remains optimistic, but the mechanics quietly change. At scale, even small miscalculations cascade into systemic disappointments. A single quarter of slowed growth becomes a narrative fracture. Once belief cracks, valuation compression follows with precision. This is not failure, and it is gravity. No company, no matter how dominant, escapes the limits of scale. History does not punish success. It enforces proportion, and proportion always returns. Modern markets operate under the assumption that buyers will always exist. Liquidity is treated as permanent, reliable, and infinite. But liquidity is not a resource, it is behavior. It exists only when participants believe prices will recover. ETFs and index products promise instant tradability, but rely on fragile market depth. In calm conditions, this structure appears efficient and stable. In stress, it reveals its true nature: synchronized exit risk. When selling pressure increases, market makers widen spreads or step away entirely. Algorithms detect momentum shifts faster than humans can react. What begins as rational rebalancing becomes forced liquidation. Liquidity evaporates not because assets lack value, but because confidence collapses. Price discovery disappears precisely when it is most needed. Investors discover that selling is easy only when no one else is selling. The same structure that magnified gains magnifies losses. Index concentration ensures that pressure converges on the same stocks simultaneously. There is no rotation, only compression. Liquidity does not fail gradually, it vanishes abruptly. Markets do not fall because everyone panics. They fall because no one can exit at once. This is how orderly systems break violently. Market collapses do not begin with headlines or breaking news alerts. They begin with subtle changes in tone, guidance, and language. A single Magnificent Seven company revises expectations downward. Carefully, rationally, defensively. Analysts adjust models, not alarms. Media frames the shift as healthy normalization. Algorithms, however, respond without interpretation. Price thresholds trigger rebalancing across funds, pensions, and ETFs. Selling increases not because fear spreads, but because rules activate. Volatility rises, forcing leveraged positions to unwind. Margin requirements tighten across institutions simultaneously. Risk models update backward, amplifying present stress. What looked isolated becomes correlated within hours. Passive flows reverse direction for the first time in years. Confidence erodes not from loss, but from speed. Investors realize exits are narrower than expected. Reassurance replaces analysis in public messaging. Internally, liquidity desks prepare for disorder. By the time panic reaches retail investors, positioning is already broken. The collapse does not announce itself, it unfolds. And by the time it is understood, it is irreversible. Collapses never begin with the weakest participant, but with the most trusted one. When a Magnificent Seven company breaks expectation, it destabilizes belief, not just price. Markets tolerate failure at the edges, but not at the core. A single earnings miss becomes a referendum on the entire system. Forward guidance matters more than present results at extreme valuations. When guidance softens, it signals limits, and limits are fatal to growth narratives. Analysts do not ask whether the business is healthy. They ask whether it can still justify its multiple. Multiples exist only as long as future dominance feels unquestionable. Once doubt enters, valuation becomes arithmetic instead of imagination. At that moment, repricing accelerates faster than explanation. Long-term investors become short-term risk managers overnight. Institutions reduce exposure not because they fear collapse, but because models demand compliance. The first fracture is quiet, rational, and defensible. That is what makes it contagious. Other Magnificent Seven stocks fall in sympathy, not logic. Correlation replaces differentiation. Diversification fails precisely when it is most needed. Confidence does not shatter, it leaks, and leaks spread faster than explosions. This is the moment the collapse becomes unavoidable. The modern market is built to synchronize behavior under stress. ETFs rebalance automatically, selling what falls and buying what rises. In concentrated indexes, selling pressure converges on the same stocks repeatedly. This feedback loop accelerates drawdowns beyond fundamentals. Margin calls amplify selling regardless of long-term conviction. Leverage transforms volatility into obligation. Risk parity strategies reduce exposure simultaneously across asset classes. Bonds fail to hedge when rates and equities move together. Liquidity providers retreat as spreads widen. Price discovery disappears inside algorithmic noise. What appears as panic is actually coordination without communication. No central actor controls the process once it begins. Attempts to stabilize prices arrive too late to matter. Markets do not wait for explanations or reassurances. By design, they react first and rationalize later. This is not market failure. It is market logic executed at scale. Systems optimized for efficiency sacrifice resilience. When stress arrives, efficiency becomes fragility. Contagion spreads because structure demands it. The collapse proceeds exactly as engineered. Most Americans do not realize they are heavily invested in the Magnificent Seven. They never chose these companies directly. Exposure arrived through default options, target date funds, and index allocations. Retirement security was quietly tied to market concentration. The promise was stability through diversification. The reality was dependency through automation. As prices fall, long-term savers absorb losses they cannot hedge or exit. Time, once an ally, becomes irrelevant during systemic repricing. Withdrawals increase as confidence erodes. Forced selling meets falling prices in a destructive loop. Pension assumptions break under sustained drawdowns. Underfunded systems face political and fiscal pressure simultaneously. Losses are socialized slowly, invisibly, and without announcement. Retirement was never designed for synchronized market exits. It assumes stability, continuity, and growth. When those assumptions fail, the burden shifts quietly to individuals. Responsibility replaces guarantees. Risk was transferred, not eliminated. Americans discover they were never investing, they were participating. And participation offers no protection during collapse. Financial media does not lead market understanding. It follows market positioning. Optimism persists until denial becomes impossible. Language softens reality during early-stage collapse. Declines are framed as corrections, rotations, or healthy resets. Reassurance replaces analysis. Experts emphasize long-term fundamentals as prices deteriorate. Historical comparisons are selectively optimistic. Structural explanations are delayed or avoided. By the time warnings become explicit, exits have narrowed. Retail investors receive clarity only after repricing is complete. Narratives shift only when protection is no longer possible. Confidence is maintained to preserve order, not truth. This delay is not malicious, it is systemic. Stability narratives prevent panic, but also prevent preparation. Information arrives after consequence. Markets move faster than understanding. Public awareness always lags institutional action. The truth is released once it no longer matters. This pattern repeats in every collapse. Silence is the final warning. Market value does not disappear. It reassigns. The $7 trillion evaporation is not a single event, but a process. Valuations compress as growth assumptions reset. Multiples normalize under pressure. Future cash flows are discounted more aggressively. Certainty premiums vanish first. Momentum reverses into resistance. Capital seeks safety, not opportunity. Repricing accelerates as belief collapses. What once justified premiums now demands proof. Even strong balance sheets cannot defend inflated expectations. Market leaders fall hardest because they carried the most belief. The decline is uneven, relentless, and rational. Volatility becomes structural rather than temporary. Recovery narratives fail repeatedly. Confidence does not return quickly once broken. Value investors wait. Speculators exit. Long-term holders reassess permanence. The evaporation completes without drama, only adjustment. Companies can survive even when stocks collapse. Market leadership does not guarantee shareholder protection. Some Magnificent Seven firms adapt through contraction. Others stagnate under their own scale. Dominance becomes inertia. Innovation slows as preservation takes priority. Capital allocation shifts from expansion to defense. Buybacks pause. Hiring freezes spread. Strategic narratives narrow. Power consolidates internally as growth options disappear. Market leadership no longer excites, it burdens. Survivors emerge smaller, disciplined, and less mythologized. Casualties linger as symbols of excess. The market does not destroy companies equally, it removes illusions selectively. Survivorship does not imply recovery, it implies endurance. Shareholders learn the difference too late. Survival is not victory. Concentration always increases efficiency before it increases fragility. The Magnificent Seven were not anomalies, they were outcomes. Passive investing rewarded size without judgment. Liquidity assumptions masked structural risk. Growth narratives replaced valuation discipline. Scale eliminated redundancy. Comfort replaced caution. The system optimized for upside only. Downside was assumed manageable. History shows that assumption always fails. No system escapes reversion. Imbalances correct eventually. Timing is unpredictable, but direction is not. Collapse is not punishment, it is adjustment. The market enforced balance after belief exceeded structure. This was not sabotage or surprise, it was accumulation reaching limit, the result of success taken too far. Inevitability does not feel obvious until it passes, then it feels inevitable. Markets rarely replace concentration with equality. Power fragments before reconsolidating. Capital disperses temporarily. New narratives compete for attention. Infrastructure, defense, energy, and real assets gain relevance. Smaller leaders emerge cautiously. Risk premiums remain elevated. Growth is scrutinized instead of celebrated. Innovation continues but under constraint. Markets become selective again. Dominance becomes suspect. Stability becomes valuable. Excess is penalized. Memory of collapse shapes behavior. This phase lasts longer than expected. Confidence rebuilds slowly. Leadership looks different each cycle. Replacement is never immediate. The vacuum persists, and uncertainty governs. This collapse is not about technology. It is not about innovation failing. It is about dependency disguised as progress, centralization masquerading as efficiency, safety outsourced to automation, risk hidden by familiarity, belief replacing analysis. Markets reflect structure before sentiment. When structure fails, sentiment follows. The Magnificent Seven were trusted too much. Trust is not diversification. Scale is not safety. Dominance is not permanence. These lessons repeat across history. Empires fall the same way markets do. Quietly at first, logically throughout, completely in the end. Understanding arrives last, always. 7 companies held up an entire market. An entire market supported a nation's retirement. An entire nation trusted the structure without question. That trust was never tested until now. Collapse did not require malice, only concentration, only comfort, only belief. History never asks whether we are ready. It only asks whether we are paying attention. The Magnificent Seven were never invincible. They were merely unquestioned. Every system breaks at its strongest point, because that is where pressure accumulates. The question is no longer whether collapse occurs. It already has. The question is who understands it first, who adapts, who survives the adjustment, and who trusted the illusion too long.